Trading is like maths, and there is a simple formula that's been tested by thousands of traders that you can start to follow. And once you do, you finally solve trading. So in this video, I'm going to walk you through the formula step by step. And if you stick to the end, I'm going to give you a bonus tip, which could honestly massively increase your win rate. Okay, so the first part of this formula is bias. Now we hear about this all the time. Bias, bias, bias. What does it actually mean? It literally means what is the most likely direction for the market, right? So whatever market you're trading, all you need to do is get on the chart, on the 4-hour chart, and ask yourself, what is price most likely to do next? And there's three things that a market can do. It can either, let me get this up for you. It can either just continue upwards, continue downwards, or just consolidate, right? And just do nothing for who knows how long, right? Now, how do we actually determine bias? It really boils down to just one concept. And literally, it's almost going to be 6 years since I started trading. And the only concept you need to learn and the only concept you need to master for this trading strategy and trading in general is a concept called liquidity. Now, liquidity is not an indicator. It's not a pattern. It's not even a theory. It's a concept. It's how these markets actually move. Now, for those who don't know, in a previous lifetime, your boy did a maths degree. And the one thing every professor would do, and if you've done maths in any sort of detail, we will know this. They always ask for proof, right? Proof. So I'm gonna give you a little bit of proof here because I feel like for every trading strategy, if you actually know why it works, you're going to be so much more confident, especially during losing streaks, that you're actually going to stick to the plan, right? This isn't just some indicator. It's not some concept I made up. This has been around since the beginning of time. So liquidity is simply stop loss orders. And the only reason, and make sure you understand this, there's one thing you take away from the video, let it be this. The only reason these markets move, and by these markets move, I mean every financial market, including crypto, gold, whatever you trade, is for stop loss orders, right? The markets are only going to move for where the money's at. Me and you, so regular everyday people, we are irrelevant to these financial markets. We mean nothing to these markets. The only people who matter, and write this down, are central banks, big institutions, and those with billions, right? If you don't have at least $1 billion to trade, you are irrelevant to these markets, right? The markets are only going to move for those who have billions of dollars, and those who have billions of dollars, they can't trade on, well, they can trade in the 1 minute chart, but they're not going to do their analysis based off the 1 minute chart. They're going to do it on the daily, weekly, monthly, and 4-hour chart. So the way these markets move are from major highs and major lows on the 4-hour chart, because at those major highs and lows, there will be massive clusters of stop loss orders. Just think support and resistance, right? So remember support and resistance. What do the books teach us? That price is going to bounce off this level, continue lower, and you can put your stop here nice and safe. Now, what people don't tell you, what the gurus don't tell you, is support and resistance does work, but it has a tiny win rate, right? So 20%, 15% win rate, and you're going on 10 losing streak all the time, right? Now, everyday people like me and you, that is almost impossible to deal with. But if you're like a hedge fund, that's fine, right? So some people ask me like, oh, Atif, why did large funds use support and resistance? Some of them still use it because they know, like, I don't know, they might lose 9 out of 10 trades, but when they win, they make a 20 to 1. So technically they are profitable. But for me and you, instead of targeting support and resistance, having a tiny win rate, if we flip it on its head and use liquidity and instead target stop loss orders, we can trade like smart money, we can trade like the big banks, and we can have a way higher win rate. So the only reason these markets are going to move off of major highs and major lows on the higher time frames, because that's where liquidity is. And I always say this analogy: if you're Goldman Sachs and you want to buy $1 billion worth of Australian dollar, you need someone who's selling billions of dollars worth of the Australian dollar, and you're not going to find that on the 5-minute chart. You're going to find it at 4-hour highs and lows, and of course, same thing on the daily, weekly, and monthly. But we use the 4-hour chart because it shows us the most liquidity pools. So what does this mean for us as traders, right? That right there was like a 2-minute proof or whatever. The best I could do, right? I'm not going to talk about it for ages. But what it really means for us as traders is when we get on the chart, the only thing we really want to look for is the liquidity. Now, I know you can study order blocks, fair value gaps, weekly trends, and all that good stuff. But really for this strategy, and all you need for profitability is you just need to target liquidity. So what you're going to do is you're going to get on the chart at this point right here. So you're going to open the chart and just imagine this is whatever market you like. So if you like, I get loads of guys asking me, does this work in, India, Nifty 50? It works on every market imaginable. I cannot stress that enough. It doesn't matter what you trade, this will work. But all you're going to do is you're going to get on the chart at this point right here. And you're going to ask yourself, okay, you know how I said in the beginning, there's 3 things a market can do? Is price more likely continue higher and take out, it's already taken out this liquidity pool, take out all, look at all these highs here, right? All the stop loss orders around here, right? Liquidity around these highs. Or is the market more likely to continue all the way down and, I don't know, maybe take out this low? Or is it likely to do Nothing, right? Now, hopefully it's pretty obvious. And again, I always say this, what you should do, let me get my indicator up. I don't know why it's vanished, but you're going to invite only. Atif Liquidity Toolkit. This indicator here, which Flux Charts kindly built for me. I know it's very complicated here. It literally gives you signals, alerts, everything. But for this, for what we care about now, let me just disable everything. We've got all these take profit levels. Signal, let's get this off. All we really want for this indicator, and again, you can find it in the description down below. We won't mention sweeps for now. Is it will simply plot the major highs and major lows. Where's the major low? All the way over here, where liquidity is at, right? So this indicator does all the hard work for you, which is why I absolutely love it. So you can find this definitely in the description, always in the description, maybe in the pinned comment, who knows. But right here, this is a daily and 4-hour major high, right? Lots of liquidity right here. So it's really easy when you've got this indicator to just be like, oh, price is just going to continue upwards and take out this high over here. So what does this mean for us as traders? We know that price is going to go for this major high where there's lots of liquidity. What it means, and what it simply means, is we are bullish, right? We are bullish. We've done our bias. Bias is, by the way, it's not the hardest part, but it is a very important part. If you don't have a bias, everything else will fall apart. But we have our bias. We know that price is likely, right? No one knows for sure, but it's very likely that price is going to continue upwards and take out this high, right? And you can imagine on the lower time frames, lots of retracements for you to enter on. So now that we've got our bias, we're going to go down onto our entry time frames, and we're going to look for something that most people don't understand, which is a liquidity sweep. Okay, so here we are on the 5-minute chart, and we have our bias. We know, and this is what we did in the last few minutes. We know that price wants to go for this 4-hour liquidity pool over here. Actually, let me just mark this out for you. So this is the 4-hour liquidity pool that we just talked about. Let's just keep this out. 4-hour liquidity. And we know that the markets are likely to go up and take out this high. However, if you've been trading for any length of time, and even with just a bit of common sense, right, you know the markets do not move in straight lines, right? And, again, most people don't understand this. The old adage of buy the dip, right, buy the dip, buy a fair value gap, and ride price up. This also does not work. This is why so many traders struggle. They get the bias right, and they get the entry right. They enter on a bullish fair value gap. They know we're going to go for this high, and they want to see this, but they get punished and they lose money. And the reason why is because they haven't waited for something called a liquidity sweep. Now I'm going to show you what this is using this blue chart right now. So let's say you're bullish, price shoots off. This is what a sweep is. It goes just below an old low, right? Just below an old low where someone would have their stop loss orders, right? Just below an old low. It doesn't come all the way down here. It goes just below an old low. Usually it's a wick, not always, but usually it is a wick. And then price shoots off in the opposite direction. And then and only then, it gives a high probability retracement for smart money, fair value gaps, order blocks, and then price shoots off, right? So this is why some fair value gaps fails, others do work, right? It's because people haven't waited for a liquidity sweep. So I'm going to put a nice picture on screen now of a sweep so you can just digest it, pause it, have a look at it. And then as always, I want you to see it, right? So this is the picture here. Can you see this sweep anywhere in price action? have a few seconds to guess. Not guess, but like think about where you would actually see it in price action. But yeah, if you could see it, congratulations. It's right here. Let me just move this down a bit. This is our sweep here. So right here, it's not really London's low, but there is liquidity at this low and this low here. And what does the markets do? Instantly, you can see this wick here. It wicks just down, takes out lows here, instantly shoots off in the opposite direction. High probability retracement for all smart money traders, and then ride price off. Now you'll notice price does not take out the 4-hour liquidity pool. That's absolutely fine. Very normal in day trading. What's going to happen is the markets will consolidate until Asia, and then Asia will probably give a setup, or London will, right? Very normal for day trading. So this right here is our sweep. And as always, let me plot this for you. If you've got the indicator, it'll plot the sweep. Now, I think what it's done is it's plotted the first candlestick that causes the sweep. And really does not matter, right? It basically points your eyes on where to look at, right? So this right here is the whole sweep. And this wick right here is just a massive giveaway. And it's almost a little news event, but this wick points all the way down, grabs liquidity here, and it instantly shoots off, literally gapping off in the opposite direction. High probability retracement, ride price off. So let me just, let's just remove the indicator because we don't really need it anymore. What do we do now, right? We've got our bias. We know that, the markets want to go for this high. We have our sweep, which is this, right? We're not looking for a random, sell the rallies, buy the dip, buying a fair value gap. We're waiting for our sweep. All we need now is our entry. Now, I normally say fair value gaps, but I'm going to do something different. And this is, you know how I mentioned in the intro that this will actually boost your win rate a lot? And if you watch my video for a long length of time, and maybe if you're in my private program, you'll know this. Your boy, I recommend fair value gaps just because I think it's so easy for like a beginner. But for me, what I always do is I literally get the Fibonacci. I take an optimal trade entry. So I take the Fibonacci from the low to the high, and I enter on the 0.705 level. So I know people are going to ask me right away. This level here, there's no magic in the Fibonacci. It's just this level I always enter on. 0.705, right? I think it's the same one that ICT used years ago when I was learning from him. So that's just what I've used. And then all I do is I simply enter on that. I mean, my stop is literally always at the low, enter at the 0.705 level, and I always hit, or I always target, a fixed free risk reward ratio. And that right there is as mathematical as trading can get. 4-hour liquidity, wait for a sweep on your entry time frame, use the Fibonacci and enter. And if you want a trading strategy that does not have liquidity, go check out this fair value gap trading strategy that I've made, which is simple, that literally anybody can start to use.